Santosh, good evening. Welcome to the show. We have talked a lot on ELSS, but then just to begin the conversation, I want to understand how is an ELSS fund different from a normal mutual fund?
Hi, Kavita. So the ELSS fund or any kind of diversified equity fund is not very different from each other. Only difference being the ELSS fund allows an investor to actually claim exemption on the income that one invests in ELSS funds on an annual basis. And the advantage of that becomes that the moment you actually put money, you save instant tax of up to 30% of your investment in that sense. So you get instant return in some form, in the form of tax saving. And second aspect, which actually differs and is very, very advantageous to the retail investor, is that it's a lock-in of 3 years. So we all know most people in equity investments actually don't end up making good return because they don't give time to their investments. But in ELSS funds, you automatically are locked in for 3 years, and that basically forces you to give time, and hence compounding follows. Another aspect of the entire thing is even the fund manager has enough visibility that you as an investor are going to give 3 years to him or her to perform and outperform the benchmark. And hence, typically you would notice that most ELSS funds actually generate very healthy double-digit return any kind of period, either 3 years, 5 years, 7 years, or 10 years. It'd be rare to find an ELSS fund actually not delivering on performance. And in fact, I have an observation to make here that even the worst performing ELSS fund over 5, 7, or 10-year period will actually give you higher returns than the fixed income instruments available in the marketplace on tax saving.
But when you talk about comparing tax saving options, Santosh, a lot of people also want to invest in insurance product. And most of these decisions are really taken just before the deadline, and people end up making wrong decisions because of this. But then, if I want to compare ELSS over an insurance tax saving product, what would that product be? And commonly, it's the ULIP that people end up investing in. But does it make sense to invest in ELSS rather than going into a ULIP and locking yourself there?
So I think it depends, Kavita. First and foremost of rule of financial planning is never mix investment and insurance. So if I were to follow that principle to the hill, then I would actually recommend don't ever use insurance products for tax saving. But ULIP, it becomes a gray area in my opinion. It's not that ULIPs are actually bad. They used to be very bad products earlier because of the cost structure. But now there are a lot of ULIPs in the marketplace where the cost structure is quite favorable to the investor. But what happens is the fund performance of ULIP funds is actually not that good. And unless you are somebody who can actually use those funds to really figure out what kind of fund you should be investing in, what kind of marketplace time, and also possibly use advantage of free switch-ins and switch-outs. If you can't take advantage of those features, then ULIPs can turn out to be very bad product for you. So I would say that don't ever mix investment and insurance. Actually keep them separate, far better. If you are a very seasoned investor, you can use ULIPs, but otherwise stick to ELSS funds.
Now let's dive deeper actually in ELSS, and I want to understand because we are talking about a tax saving purpose right now, Santosh, does it make sense to do an SIP in an ELSS, or one should be investing in lump sum? Because we also have to keep in mind that if an individual wants to come out of the product after 3 years, would it be easier to come out in a lump sum way rather than having each and every SIP complete 3 years?
Yeah, so if you were to look at that convenience of withdrawal, where when you put in money in lump sum at the end of the year or beginning of the year, and you actually can take that money out all put together into one go after 3 years. Whereas in SIP, every installment gets logged in for 3 years. But I think the moment you take that kind of view, Kavita, which is basically you want to only put for 3 years, you take a very myopic view on ELSS SIPs or ELSS funds. I would recommend that one should use ELSS as a tax saving instrument. In fact, most people should be actually maximizing their ELSS funds SIP only when you reach that limit of 8,000, 10,000, 12,000, where you are not getting additional benefit of beyond Section 80C 1.5 lakh rupees, then only consider the diversified equity funds. If you do that, what happens is you actually by definition give 3 years to your SIPs. And if you don't withdraw money after 3 years and have a long-term view, chances are very high that you retire as a crorepati only on your ELSS funds. I'll give an example to you. If you invest in SIP of just 5,000 rupees every month in ELSS funds and continue that for 20 years, and you get a good performing fund for yourself, at a 12% CAGR, the amount turns out to be like almost 50 lakh rupees. If you do the 10,000 rupee SIP, the amount turns out to be 1 crore rupees. Now that kind of healthy compounding will come only when you give time. And if you're able to give that long a time, then whether the SIP is locked in for 3 years or your entire lump sum is locked in for 3 years, it will not matter to your financial goals. You will achieve them for sure. So I would recommend that don't look at that limitation as a negative aspect. Look at it as a positive aspect, because you actually get to give 3 years of your time to every SIP for long term.
All right. Now let's talk about lining this particular investment with your financial goals. So Santosh, what happens is people usually, if they are aware of a tax-saving investment instrument, they really don't count in that product as a part of their financial portfolio, or as a part of completing their financial goal. How important it is that if you have invested in an ELSS, it will be beneficial for you if you line it up to a goal. Can that be done? It's just not a tax saving instrument that we're talking about. People often forget that it can be lined up with a goal as well.
Of course, I completely agree on that. In fact, you would actually be far more committed to your annual tax saving maximization as well as wealth creation if you attach a goal to it. And because you are, as an individual, be it salaried, be it self-employed, be it a businessman, you are going to be earning for good 25, 30, 40 years of your life. And if you look at ELSS funds and attach a long-term goal to it, be it partial retirement savings or long-term children's education goal or child's marriage goal, you would possibly notice that entire goal, some of the entire goals, or maybe large portion of the goal values can be accumulated only by doing this mandatory tax saving. So look at this, that you are actually getting twin advantages of wealth creation as well as tax saving if you choose ELSS funds. I would add one more thing. Let's not forget the fact that if you invest 50,000 rupees or 1.5 lakh rupees annually, be it via SIPs or lump sum, you actually get up to 20% kind of up to 20-30% tax benefit on it, which means that should be added to your returns. And so if you added that to your returns, it becomes extremely high compounding that you are able to generate on your investments. And hence attaching to a goal will actually make it far more committed than it would otherwise. And I think it can be very big wealth creation tool in hands of every retail investor in the country.
One common mistakes that people usually end up doing when investing in an ELSS fund is they go wrong in selecting the kind of option within the scheme. So what type of options are we talking about over here, and what is a common mistake that one should really be careful of not to do?
Yeah, Kavita. So actually, that's a very kind of common mistake that many people used to make earlier, and even now that has not stopped. What used to happen is, even today's happens is, many mutual fund companies declare some kind of dividend. It's now called income distribution cum withdrawal plans. So they will declare some kind of payout towards the January, February, March quarter, or for that matter, declare something in the April, May, June quarter. And what will happen is people actually line up to invest money in that fund because they know that some portion of the money is going to come back very fast. So if I'm investing 1 lakh rupees for tax saving, I will get some 5-10,000 rupees back instantly in the form of some payout. And I would actually not put entire money from my pocket for tax saving. That becomes a very short-sighted view. In fact, there are two disadvantages to this. One is you don't give compounding to your investments because money keeps coming out from your own investments. The NAV actually falls after declaration of the IDCW payout. And another disadvantage becomes is in today's times, in last few years, the rules have changed where your dividend on dividend incomes, that as it's classified in income tax rules, that payout is taxed at your income tax bracket. So if you're somebody in a 30% tax bracket, you're going to actually make entire IDCW payout as part of a taxable income, and you will lose compounding again on it. So I would actually say that you should not consider opting for IDW plans in any kind of investments in mutual funds, be it equity or debt or hybrid, it's far better to you decide when you want to withdraw money as a profit booking or principal withdrawal after 1 or 3 years, depending on the kind of category of scheme, and not fall prey to this gimmick of getting a healthy payout every few months or few quarters.
One thing what people usually miss out on doing is first mistake, according to me, maybe you can elaborate on this, is people have more than two ELSS funds. Are they really required, or one is more than enough, Santosh?
So, Kavita, actually, one of the limitation on industry today is in ELSS category doesn't have passive option. So, by definition, you are forced to choose an actively managed ELSS fund, which means that you would actually be required to track performance every few years. And it may happen that you may start an SIP or make a lump sum investment in a good performing, actively managed ELSS fund a few years ago. And for the new investment, when you're making this year, and if the fund is not performing that you've invested in, you may consider another fund. So it's not an unhealthy practice to have more than two funds or more than one fund. But I would recommend that as you commit to one scheme simply because of one reason, you would actually be making it far easier to manage your portfolio. And if you are choosing another fund for lack of performance in the previous fund, then after the lock-in gets over, migrate that money by redeeming from that fund and reinvesting in the new fund that you're investing. Simply because it make your life far easier. Don't do it for reinvesting or saving money every year by actually deploying money from your existing ELSS funds. Do it only when there is kind of underperformance in your existing fund, and choose a better performing fund.
One scenario I want you to explain us. Now, what happens is, for example, someone is doing an SIP in ELSS fund. You've taken the benefit for a year on your tax saving investment. The other year, you want to increase the amount of your SIP. Can you do that in the same ELSS fund and take the tax benefit?
Of course, you can. You can always, a lot of, wealth tech apps like ET Money allow you to modify your SIP amount. So you can actually technically modify your SIP as your income keeps going up and you have more requirement or higher tax saving investment possible. So you can modify your SIPs. Nothing stops you to actually do that in mid of the year as well. To be honest, it's not that you are actually putting money in ELSS fund and you're locked in fully for that amount for life. You can keep reviewing your ELSS SIP amounts every couple of years or every year for that matter.
What about recycling your ELSS investment and talking about completing a 3-year duration and then withdrawing that money and again reinvesting that entire amount in ELSS fund? Do you think that's a strategy one can adopt?
So in the earlier kind of part of one's life stage, when one is in early 20s or early 30s, one may actually do this because one doesn't have enough savings in life to actually keep investing in tax saving investments every year. A lot of people take advantage of the shorter lock-in period of just 3 years, withdraw money after 3 years and reinvest in the same fund or another fund, just to basically avoid putting money from your own pocket. Now that is something which you may do as a convenience, but remember, you're actually harming long-term compounding and wealth creation impact of tax saving investments. I just covered as an example, if you invest 5,000 rupees every year for 20 years at 12% CAGR, compounded annual growth rate, you actually accumulate a corpus of 50 lakh rupees. And if you do 10,000 rupees every month, you accumulate a corpus of 1 crore rupees at 12% CAGR. Now, why would you want to disturb that compounding is a question that I would ask for somebody who's trying to recycle funds. If you are having financial difficulties in a specific financial year and not able to make new investments, maybe you'll kind of use that kind of advantage of shorter lock-in period of ELSS funds, but making it a habit actually will be detrimental to your long-term wealth creation goals, in my opinion, Kavita.
Not a specific question to ELSS, but then tax-saving investment in general, just to sum up the conversation, Santosh, should one be really borrowing money to do tax-saving investments?
I would never recommend that, Kavita, because see, look at this from a fact that what you're going to do when you're investing money for tax saving investments. There are products which will give you, like ELSS funds might give you like 12%, 30% CAGR on investments, and a fixed income instrument might just give you about 7.1 or 8.5% CAGR on your investment. Now, actually borrowing money, which actually would be even at a 9%, 10% attractive rate, or maybe 15%, you actually are not going to benefit from your return on investments of tax saving by giving interest on it. So at any point of time, borrowing money and investing in any kind of asset class is actually not a good decision, simply because the cost of interest might be more or equal to the return on investment that you might make. I would never recommend that.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.